Hello everyone. So let's start discussion on very important topic, guys, and that will definitely get asked in the development financial institution interview. And because it is, the huge amount of investment, and they need to be do the finalize the credit rating for the large infrastructure projects or other kind of projects. So this question is how to validate the and finalize the credit rating large infrastructure borrower or different kind of borrower. So how to validate that thing? You need to, the infrastructure project structuring financing is a totally different way of doing financing. It is and the done the project financing. So let's start discussion step by step, where we are going to discuss the six step framework, and then the how the cash flow is a king for that, why we are not looking for the balance sheet items. Then we are going to do the, to infra specific checklist, what are the things that comes under the infra specific checklist. And then we will do the case study. It's small case study. I will help you how to understand the and validate the and finalize the credit rating from that case study. So let's start a discussion on these, guys. While you are working in the risk management team for the DFI, development financial institution, like a NaBFID, like a NHBI, National Housing Development Corporation, or the Exim Bank, or the SIDB, or the NABARD. So you need to do the validation or the finalize the credit rating of the borrower, because its size of the investment is huge. So the what DFI wants, the six-step framework, I will explain you how the DFI wants to answer from you while you are answering that question's answer. So the first, you should mention model of selection, quantitative techniques, qualitative things which you are going to cover, sponsor and structure, benchmarking, and the committee notes. You should think that thing in keep in mind. So in the model selection, you should select the project finance model, not a corporate model, for the specific NaBFID, National Bank for the Financial Infrastructure and the Development. So for project finance model, you need to select because it is a non-recourse finance, long-term financing. And then you should keep in mind to calculate or you the data will provide it for the debt service coverage ratio, loan life coverage ratio, for the project life coverage ratio, plus the stress scenarios you should keep consider, and to do the analysis. So you create your own scenario, you create your the Python base or the Excel base to calculate the debt service coverage ratio, loan life coverage ratio, or the project life coverage ratio. So in the debt service coverage ratio, you should do the cash flow available for the debt service divided by the total debt service, like a principal and the interest rate. So it's the ideal ratio should be 1.25 or the 1.15x. And the loan life coverage ratio, where you should consider the net present value of available cash flow for the entire project life cycle, and the overall debt service for that project on the life of that project, and the project life cycle coverage ratio. Then we will move on the qualitative things, where that project is a completion, what are the commercial operation date, how much time will require, is that time a feasible, technical feasibility, financial feasibility, regulatory and compliance feasibility, revenue risks, completion risk. So that thing we do in the qualitative. And then off taker, who is the off taker for that project, like if it is a road project or the construction project, so their off-taker might be National Highway Authority of India, NHAI, or if it is the greenfield, if it is the wind energy or the solar energy product. So in that case, the off-taker will be the Solar Energy Corporation of India. Then regulatory. So in regulatory, different kinds of regulatory and ECG risks. So this environmental, social, and governance risks for that project. So then we do the sponsor and the structure. So you need to understand who is the sponsor of that project, how much the equity share of that sponsor, what are the debt service reserve account, escrow account, and the waterfall, what are the TRA, trust and retention account for that. So you should understand that thing, and to do the proper how credit ratings for these projects. And then benchmarking. So you should internal portfolio benchmark, you should do the crucial rating, ICRA rating. You should validate their rating with that sponsor, understand their rating structure, and do the internal rating for that projects and the committee note. So note, review and approve the surveillance. So you should do the note, review the and approve, and then the surveillance for this thing. So let's move on the next slide, which is the cash flow is a key king and key numbers to score. So matrix, so average debt service coverage ratio, minimum debt service coverage ratio, loan life coverage ratio, and the trail period. So the safe best debt service coverage ratio is 1.25 of x, where the available cash flow of debt service is high as compared to the principal and interest. And in that case, the average for the red flag for the NaBFID or the development financial institutions, if debt service coverage ratio is below 1.5x, and then the minimum service coverage ratio that should be at least debt service coverage ratio is 1.1x. And in case if that comes below the 1.5x in any year, so that should you consider a red flag for the NaBFID or the development financial institution. Then the loan life coverage ratio, so it should be 1.3x of loan life coverage ratio, where we should consider the net present value of the cash flow available for debt service for the entire loan life cycle, and the overall debt coverage, so where the entire loan life cycle, the debt and the interest rate that receive. And then the 1.52x, it should be red flag for the loan life coverage ratio, and tail rate should be 20% or below the 50% should be the red flag for the development financial institution. So validate the cash flow available for debt service. You should check the lender independent engineer report, run three cases: base case, stress case, and the break even point. What point the interest and the the no profit no loss for the firms, you should validate that thing. So let's move on the next slide, which is the most important slide, guys, where we are discussing on the infra specific risk checklist. So what are the infra specific checklists we need to validate while doing the or validating or finalize the credit rating? So you should consider the completion risks. You should check, is land 100% acquired, or how much the percentage current stage land is acquired for that project. And then we need to check the contract type for the engineering procurement and construction contract. It is a fixed term contract or the fixed type contract, or what are the types of the contract for the operation and maintenance? It is a fixed term contract or the fixed cost contract. Then we need to check the counterparty risks. It is the most important, guys. So it is the Solar Energy Corporation of India Limited or the National Highway Authority of India Limited. It is itself the government bodies that work for the government. So there is the counterparty risk is a very low, and it is a strong thing. We need to good to go for such kind of projects. And weak, the DESCOM and not. So DESCOM specifically the firms that do the distribution business. Okay, that is a distribution company that comes under the electricity. So DESCOM is electricity utility that purchase power from generate and supply to end user. So that collect the power from who generated, like the sponsor who you do the infrastructure project, who generate the power and that supply to the end user. So that's are the DISCOM firms. So DISCOM are the finalized link to power chain responsibility for grid maintenance and metering billing in India. So there are 72 plus DESCOM primary state owned through the some private such Tata Powers and BSCC. So India, Maharashtra, MSCB is also one of the DESCOM. So let's move on the regulatory risks. It is also the important risks. Tariff approved, change in law protected. So if there is a change in law done by the regulatory or tariff approved by the regulatory, so that thing we should consider. We should need to analyze that thing. And then the refinance risks, bullet payment, tail period advocate. So what are the bullet payment, what are the risks refinancing once done by that finance, and the tail period advocate, what are the impact of the change in the interest rate. Then we need to consider the environmental, social and governance risks, where we do the EIA done. And then the coal negative overall delay and the development financial institution policy, we check that the financial policy. So guys, lastly we need to do one small case study for to understand the to validate and finalize the credit rating for the firms. So where we discuss on the facts, validation, and the judgment done by the analyst or the credit analyst or the risk management team analyst. So where the PPA, so power purchase agreement, it is done by the Solar Energy Corporation of India with the 25 years at rate of 2.45. So how much the energy we generated by that infrastructure project that purchased by the Security Solar Energy Corporation of India at the rate, that fixed rate 2.45. And we if we need to validate that thing, so then we need to view the tri-party agreement. We need to tri-party agreement. So the tri-party agreement is a legal contract document between three distinct parties, most commonly used in real estate to involve buyer, seller, developer, and the lender. So lender is also involvement. It defines a role, obligation, and right of each party during the complex transactions such as buying under the construction properties to ensure that loan disbursement are made securely. So you should understand the type party agreement while you are working the development financial institution. And the part will cover in the type party agreement is a party involved. Okay, that there are three party, the buyer, seller, and the lender. Okay, the purpose of tri-party agreement, role of the lender, legal standing, and the key constraint in the tri-party agreement. So low counterparty risks because it's the government body who are the sponsor for the who are the uh, PPA sector for these the projects. And then the third fact is the debt to equity ratio. Guys, debt to equity ratio is most important. Here the debt to equity ratio is a 75 to 25, which is always good, and the cost is 2,400 crore. So equity is upfront confirmed by the sponsor and advocate and sponsor skin in game. Then we will do the base debt service coverage ratio. So on the base case scenario or the proper acceptable scenarios, what are the debt service coverage ratio? So it should be 1.28. So it's acceptable scenario, and we need to validate that service coverage ratio by using the lender independent engineer validation by 26 and PLF. And then the trace debt service coverage ratio is 1.45. In the stress scenario, we consider some factors like the development risks, construction risks, revenue risks, land acquisition risks, interest rate risks, or we consider the financial risks. So that scenario we consider and do the debt service coverage ratio. So operation and maintenance costs increases, or the engineering procurement consultant cost or the cost of raw material increases. So the principal maybe payment get delayed, or the there is a suddenly withdraw from the debt service reserve account. So that's we do in the trace scenario. And then the COPS rating at A. Then the debt service reserve account. It is the 6 month account where the principal and the interest will kept hold. So escrow line check and the strong structure. So final call for the stable and monitoring the great curtailment. So that's the case study for the solar energy, guys. Once again, thank you so much for attending this interesting seminar, guys, and I will best of luck for your interview and get ready for preparation. Once again, thank you so much, guys, attending this interesting seminar. Thanks.